Okay, let's go to some questions here. Okay, this was me setting up the audio. Good sound. Sam's tie looks good. All right, let's hope there is one or two actual questions here. Thank you for that in any case. Recent research shows that, this is from Peter. Hi, Peter. Recent research shows that there may be a scaling wall just over the near-term horizon. Yeah, absolutely. So scaling means that as you add the amount of training, the amount of processing units that are used, and the volume, the amount of data, and the amount of training that's done of the large language model, or whatever the AI is, that it becomes more and more powerful. As you scale it up, and you spend more money and use more resources and input more data, as you scale it up, it becomes more and more powerful. Now, people didn't predict that this would happen. This is just a empirical thing that happened. No one knows why it happens. People have different theories. I couldn't tell you what those theories are, but it is certainly true. People can't see inside of what's going on in those large language models to a point where they understand what the scaling laws are. So predictions that scaling laws will continue, and that as we spend more and more money and more resources and use more and more data, there's a limit to how much data we actually have. You can synthesize data, but there's still a limit on the amount of foundational data that you have, that AI models will become more and more powerful, but they don't know, right? That is a conjecture that they will become. And what Peter's saying here is that it looks like it might be hitting a scaling wall, that it might be plateauing. What do you think will happen to the market if this AI scaling wall does indeed materialize? I think that we will hit an AI winter. That's the way that people refer to the prediction that AI will hit a flat spot. And most of those people don't think that we're not on a trajectory to AI being utterly transformative. They just think that it's inevitable that there will be flat spots. Is there runway with how good it is today to unlock sufficient productivity gains and future returns to justify stock valuations? And would it justify a substantial correction? Look, I think some corrections are absolutely inevitable. I do think that there'll be companies that don't have enough financial resources to make their way through an AI winter, a period where productivity slows, as in the background, we're sort of developing more in A&A, and then it lurches forward again. In that period, I think OpenAI faces this danger. While their products and their models are getting better, faster and faster, they're able to raise a lot of money. But if they hit a flat spot, if they can't develop something to replace ChatGPT in the relatively near future to make the market excited again about their prospects, then they won't be able to raise money, and it'll be all over for them. They'll get bought out by somebody at a relatively low valuation. Other companies like Google and Meta and Amazon and Microsoft, they've got such an incredible cash flow that they will, from their other products, that they will be able to sustain themselves through that. That's what I think will happen. But flat spots, of AI being, surging ahead and then going flat and then surging ahead and going flat, it's absolutely inevitable. Keen to know why no finance jobs are impacted, as it will be the easiest to replace. Well, I think they will be impacted. There'll be plenty of research. There'll be plenty of people doing equity and fixed income research. There'll be a lot of jobs. Most finance jobs are selling product at some level. But there'll be plenty of research jobs. There'll be plenty of, ultimately it'll affect financial advice as well. I think it will have a big impact. With the CAPE ratio, do we expect this to gradually increase over time given natural growth? Well, remember you've got the price on the top, the numerator, and you've got the average earnings over the last 10 years on the bottom, the denominator, and both of them are increasing over time. So it's not just a natural artifact of time. It's not a natural inevitability of the passage of time that it goes up, because both price, it's the ratio of price to earnings, and both of them go up over time. But that time effect should cancel out. Oh, it's from Craig Rayner. Hi, Craig. How you going? Craig is a gun scientist in the pharmacological space. Uh, let me start by saying that I don't think AI is a bubble. Okay. However, some adjacent industries, e.g., nuclear power, have had price increases that are sometimes not grounded by their financials. For example, Oklo. Yep. So people are super excited about the possibility of small reactors, uh, and they are pumping a lot of money in there. Is this an example of early warning sign of a bubble? If so, what should come next to get closer to bubble territory? Well, look, that's a great question. And it really goes to whether there's a bubble not in the public markets, but in venture capital. So in startups. And look, I don't know Oklo, but I'm going to bet that Oklo is a private company, that it's a private startup for those small reactors. And of which there's a whole bunch of people trying to create companies to create small modular reactors. And I'm going to bet that that's what Oklo is, that they are funded by venture capital money. Now, such huge amounts of money have flowed into venture capital, and they are chasing all kinds of technological ideas, have too much money flown into venture capital such that the potential returns are not matched by the risk and the amount of money flowing in. I think that has happened. And I'm quite unexcited about venture capital, to tell you the truth. I think that the vast majority of value in AI is going to be released is going to be earned by investors in the public stock markets, not in the private markets. So look, the too much money, chasing too few opportunities, and getting too excited about it. Is that happening in the private markets, in private equity, and especially in venture capital? I think that probably is happening. And then again, hi Sam, the growth rate was assumed to be, this is the G in my model, assumed to be linear, constant. So constant growth, that means the cash flows are not linear, they're exponential. They're growing at a constant rate, which means that they're growing exponentially, a constant rate per year. Let's say they're growing at 5% per year. We saw it was 3.7% above inflation. That's what's built into the price. Have you ever seen applied different functions that can align with new innovation adoption like AI that might be more like an Emacs model, i.e. more exponential initially, then saturating, slowing down? Yeah, I think that is what's going to happen. But in any case, look, I just made the assumption that cash flows were going to grow at a exponential rate where the growth rate is constant through time. But is it more realistic to think that it's going to grow quickly and then flatten out, more like an S in a sense? Yes, I think that is more likely to happen. And we could do that, but then, and we could sort of get to what the implied parameters are, but we wouldn't have, that S is going to have, because there's an area of convexity and then an area of concavity, is going to have at least two parameters that we have to back out and not one. So it's going to be complicated, more complicated than we could have worked through in our short webinar. Doug Swan says here, now we're getting to some of my favourite students here, favourite former students, if it's the same Doug Swan. Hi, Sam. Doug Swan here. Do you have a CEO or organisation in Australia that you can point to that is already utilising AI at scale or in an advanced, considered way to transform their organisation? Well, that's a good question. And look, it's quite natural to point to software companies like Canva and Atlassian. And they, of course, use AI a lot, right? They use AI to generate code to create their products, but they're in the space, right? They're in the AI space. And I take your question, Doug, as meaning, can you point to, a Wesfarmers, or can you point to a BHP or someone else who's really got a lot of deeply embedded AI that is transforming their business? Actually, just while we go to that, so one to point to would be the self-driving trucks and the self-driving trains that Rio, I know that you were a mechanical engineer, Doug, before you came to the Melbourne Business School. So, Rio, as you know, has self-driving trucks in their mines in the north of WA, in the Pilbara now, and their trains are self-driving as well. And that's AI, right? That is generative AI in the way that we were describing it earlier. So that would be an example. But I think your point, what I sort of reading between the lines, I hear in your question is that you don't think it's very deep, right? You don't think that we're very far into it, and that the implementation of AI is difficult, and that it doesn't have very much penetration yet. And look, I think that's completely right. I think that's completely right. And so and what that means is that corporates aren't spending, and households either, right? Most people aren't spending. Most people aren't using a lot of AI. Aren't paying to use AI. So corporates aren't paying to use AI. So you've got the Mag 7 spending huge amounts of money on CapEx, and you've got, and it's kind of a circular thing going on where NVIDIA which is the most valuable company in the world, is earning all this money because these Mag 7 companies are buying their chips. But the Mag 7 companies themselves are spending a lot to develop AI and their AI capacity, but they're not earning a lot from AI. They are funding it from their other businesses in an attempt, they're using their existing businesses to fund their AI build out. And it's an open question on whether that's going to work. Are companies going to spend a lot on AI products? Are households going to spend a lot on AI products? And look, I agree, if that's what you're getting at, that's an open question. Might China equally be a powerhouse of AI? I personally think that is overhyped, and that there's a whole bunch of things that give America a really significant advantage. Let me just list off three. The university system in the United States that draws in so much talent, notwithstanding President Trump's constriction of immigration, it's still a flow of global talent into the United States that doesn't exist in China. The resources available to US companies, that $55 trillion is the fact that the market cap of the Mag 7 goes from 1.2 trillion to 20 trillion. So 19 trillion of resources that can be used. I shouldn't say 19 trillion, but their market cap goes to 20 trillion. That means that when they need to generate resources to hire new people, to invest, etc., they will always be able to issue new equity. That just the access to resources because of the market cap of the S&P 500 and the whole world pouring their money into it to get exposure to the AI is like a self-fulfilling engine. So, you've got the university system, you've got those financial resources, the immigration system in the United States, and then you've just got the entrepreneurial nature. Now, you can say that of the United States, you can say that China has got an equal entrepreneurial culture, and I don't doubt that is true, but it's still true that China is the core of the Chinese economy is centrally planned. They have 5-year plans. That one came out recently. 5-year plans for how resources are going to be deployed within the economy, at the federal level, at the provincial level, at the city level. Right? This is a central planning of the economy. Now, if I give you the choice of a free market economy where the markets get to decide where resources go, and an economy where the government decides what are going to be the winners and where to send resources for innovation, which one are you going to go for? Right? Because look, if you choose the government one, then you weren't paying attention to what happened in the 20th century. Every economy that was centrally planned in the 20th century was eclipsed by economies that are market oriented. Look, there's really substantial structural reasons that we should expect that the AI innovation and creation of value is going to be dominated by the US. Okay. What if AI doesn't actually work the way the boosters claim. Well, I think that's sort of kind of laid. I think that's related to the earlier question of what happens if we hit an AI winter. Yeah, if that goes on for long enough, the market goes down a lot. That's the nature of risk. Absolutely. But look, do you want to bet against it? Really? Do you want to bet against tech? And it's also a statement. This is kind of why Justin and I sort of laid out those 5 scenarios. AI is just the extension of something. It's just a component on something that's been happening for 80 years. AI is a component of something something bigger, something that's been going on we should think about it in the context of 250 years since the dawn of civilization, since the birth of Homo sapiens 300,000 years ago, since the dawn of life, right, 4 billion years ago. The framing of it, and you got to choose one of those windows. You can choose your own framework, but I'm sort of putting out a framework to help people to choose a level of how important and significant they think AI is. And look, I think that if you are very worried that it's really overhyped, then you're in the left-hand window, right? This is just an extension. It's just one component of something that's been going on for 80 years. Paul Mackey, g'day, Paul. Hey, Sam. Thanks for running these talks. Read your CapEx observation and just to recap what the CapEx observation is that historically, and this is across decades, even across centuries, actually, going all the way back to the canals and the railways and the like, across decades or centuries and across countries, that companies that spend a lot on CapEx, on investments in capital expenditure, earn lower returns on average. I remember reading with the gold rushes from 100 years ago, the people who made the most out of them were those selling the equipment, shovels, shoes, etc., to the gold prospectors, not the prospectors. Have you considered or seen any analysis research, the thinking that goes along the lines of AI? Well, look, one way, we could go back to the dot-com bubble to sort of bring something out here. So let's just jump back. So it's 1998, right? So Sam doesn't have any gray hair. And he's sitting in his office at Dartmouth University in Hanover, New Hampshire. And people are super excited about the companies that make the plumbing of the internet. It's 1998, and the internet boom is humming along. So it's Web 1.0, and the people who make the plumbing, make the routers, the Ciscos, the Alcatels, the Nortels of the world, who make the routers and the plumbing of the internet, they think that the market thinks that they are going to make all the money, and of course they don't. It's people who build the applications on top of all of that make all the money. Ultimately, it's the Googles and the Amazons and the Apples and the Facebooks who make all of the money. And at one point in 1999, Cisco was worth $550 billion US. It was the most valuable company in the world, and now it's worth about 170 billion, which is still a lot of money. But when you sort of look at that, I look at that and I think the analog of the companies who made the routers and the plumbing of the internet are the companies who are making the large language models at the moment and making the data centers at the moment. It's quite natural to think that's the layer at which the money's going to be made, but I don't think it is. I think that the applications that are built on top of those large language models and using those data centers and using those chips made by NVIDIA, that's where the money's going to be made. Now, don't ask me what those applications are, because if I knew, then I'd be somewhere investing in them, right? But I don't know what they are. Those applications are probably being invented in dorm rooms as we speak. Just like, so much was being invented in dorm rooms in the late 1990s that came out. Where was Sergey Brin in 1999? He wasn't in Google. He was in the PhD program at Stanford. And next thing you know, he and his partner are founding and running Google, right? And I think the same thing is going to happen here. That's why it's important to be invested in the whole of the market. Not the Mag 7, not to be focused on that, not to be focused on NASDAQ, but to be focused on the whole of the S&P 500. Do you think the Victorian government's plan to legislate work from home 2 days per week, you can see me smiling here, is actually going to drive the increase in AI agents to replace these workers? You know, it's a great question. I was actually thinking about this yesterday. And again, if we jump back to the 1990s, so at the end of the 1990s, related to the excitement about AI, was the concept that firms would sort of come apart, that firms would be replaced by contractors. People who were previously employers would be replaced by people who are contractors. Let me just sort of flesh this out very quickly. Right? So there's this notion that you could organize production as a company. A company can produce stuff. It's got employees, it's got assets, capital assets inside the boundary of the firm. And most of the production gets done inside the firm. Now, you contract some things out, like you don't make your own electricity necessarily. You don't have your own law firm necessarily. You contract some things out, but you do most of the production inside the firm. And what the idea was, the very sort of modern idea in the late 1990s, a lot of this coming out of Harvard, was that companies will become hollowed out, that people who were previously employees will become contractors, and they'll work for this company, and then they'll work for another company, and they'll work for another company, and it'll become more dynamic. That's kind of how movies are made, for instance. You don't really have a company that owns assets and employees. You have a producer who produces the movie by employing actors and employing the director and the screenwriter and makeup and cameras and lighting and everything, right? And so it's a set of contracts that come together to produce the product, and then we move on to another product. And the construction industry is like that as well. And there was a feeling that employees would be replaced by contractors because of the change in technology. Now, if you insist on working from home, you're kind of saying, I don't want to be an employee. I want to be a contractor. I don't need to come into the office. I don't need to meet, you're sort of acting like a contractor in a way, right? Now, maybe I'm sort of exhibiting a bit of a prejudice here, but you are, I see, or it occurred to me yesterday that moving from working in the office to working from home is moving let me put it this way, moving in the direction of becoming a contractor. And so, look, I do think your question, I don't know if I'm answering your question or not, and maybe I'm not even saying anything interesting, but I do think that it will be an unintended consequence of Jacinta Allen's policy if it was ever enacted. It's not going to be enacted because it's covered by federal law, and the Constitution is quite clear that anything that's covered by federal law trumps state law. So, and the Albanese government has said we've got absolutely no intention of doing that. So, look, I don't think it'll happen, but it is moving in the direction of more contracting out, and that's what your question goes to. What if China ends up better at AI than the US? Cash doesn't flow to the S&P 500. I honestly don't think that's going to happen. I'm very bearish on China. We should have a whole webinar on this, and I'll explain to you why I am quite bearish on China. And it's for very good structural reasons. It's about how centralized their economy is. It's about the demographic catastrophe that they are facing. It's about the structural problems in their economy that they haven't been able to transition to a consumer economy. Anyway, let's have a webinar on that at some point. But the likelihood that China eclipses the US economically, I think, is very low, and especially in high tech. Your view on the US versus China, obviously this is kind of activating people. I didn't mean to make a lot of statements about China. Equity market. What is your view? Since China's futuristic technology is more capital efficient and more productive, should China equity be preferable? If this is true, would it not have negative impact on the US market? Why is it more capital efficient? I don't get that at all. It's a lot less capital efficient. If you want to point to a country that is capital efficient, point to India. The amount of output per dollar of capital in India is a lot lower than it is in China. China is capital heavy. And the reason it's capital heavy is because the federal government subsidizes the industries that it really wants, right? I mean, in the 5-year plans, there's a statement of which industries are going to be supported by the federal government and how resources are going to be channeled to those industries. And there's a longer term plan that overlays the 5-year plans, which just sort of sets out which industries China is going after. It's going after the energy transition industries. It's going after critical minerals. It's going after EV, electric vehicles, and a bunch of others, right? But that sort of central planning of channeling resources into industries that the government thinks are going to be the future, that's just a great way of wasting resources, right? And it's capital heavy, right? A lot of capital gets put into it, and it's also negative NPV projects. Like if your objective is to have a lot of exports or to just produce a lot of output, even if the investments are negative NPV investments, even if they earn a low return, lower than the cost of capital, what happens, right? Well, what happens is you grow the economy quickly for a period of time, but you accumulate debt. You can grow your company quickly. You can grow sales in your company quickly if you invest in projects that are crappy projects but sell a lot of product. They don't make any money. They don't make profit, but they sell a lot of product. What will happen? You will accumulate debt. Your equity will go down, your debt will go up, but your sales will go up. And I don't mean to overstate that, but there's an element of that in the Chinese economy. People point to aspects of the Chinese economy and say, and think, oh, they're so fantastically innovative and productive. But what's really going on is they're being supported by the government in a series of negative NPV projects that's misallocating capital and is causing the debt in China to rise even more rapidly than it is in the United States and in Europe. It looks good, but anyway, you can tell I'm very unconvinced that China is on the right track economically. Given the rapid advances in AI, much of the market's optimism appears concentrated in the so-called Big Seven. Yep, technology firms. They're now 35% of the S&P 500. From a portfolio theory and risk-return perspective, do you believe investors are better off concentrating exposure in these firms? No. Or does the diversification offered by broader industries such as the NASDAQ or the S&P 500 remain the most prudent approach? I like the S&P 500. Look, I mean, we don't know where the value is going to be created to begin with. It might be that, at least to begin with, that value creation is going to be cost out with AI rather than the top line of the income statement, more revenue. It's going to be reduced cost driving the bottom line. And if that's true, it's going to happen in ordinary industrial companies. It's going to happen in mid-cap companies and in companies that are in the S&P 500 that aren't in the NASDAQ. And so, look, I don't think it's worth it. You don't know. I'm not convinced at all, for the reasons we were talking about earlier, that all of the value, that a lot of the value is going to be created in the long run in the Mag 7. And it's not obvious it's even going to be created in the tech companies. I think, the safest bet is to bet on the dynamism of the US economy and the tech engine that is the US economy that expresses itself in NASDAQ companies, but in New York Stock Exchange companies as well. So, look, I think it's for me, the S&P 500 is the thing to go for, not to try and take more concentrated sector bets. How much exposure does the world ETF have compared to the S&P 500? Well, 70% of the world ETF, of the world stock index, like the MSCI, Morgan Stanley Capital International index of global equities, 70% of that is the US. Might even be 72%. So yes, very dominant. Leveraged ETFs, such as the 3 times TQQQ offer amplified exposure to equity indexes, but they are debt-backed and subject to compounding effects and path dependency. This is something we talk about a lot in my investments course. From the perspective of, and the path dependency part is really crucial. From the perspective of long-term portfolio optimization, do you view these instruments as viable vehicles for strategic asset allocation, or are they inherently suited only for short-term speculative positioning? Well, borrowing to invest in shares is a good thing, is okay. Borrowing to invest in anything is good in the sense that instead of your wealth growing at that rate, it'll grow at that rate. You're on a higher point on the risk and return spectrum. And the biggest risk is that you'll be forced out of your position at the bottom of the market. So if you invest in I don't know what the 3x in the TQQQ is, but I'm a bit worried that it means that there's 3 parts debt for every part of equity, that the loan to valuation ratio is 75%. Or maybe it might be the 3 might be 1 part equity for every 2 parts debt. Right, that's probably what the 3 actually is. That'll give you a 3 times return. So now you're growing much faster, but the danger is that if the market goes down, you think about COVID, right? If you borrowed a lot of money to invest in shares, in COVID, the market goes down 37%, and then it rebounds quickly. Now, what'll happen is market goes down, you'll be forced by the company by the brokers who lent you the money to sell the shares to repay the loan. You'll get a margin call because you started off, you borrowed 70% of the money and they had a 30% buffer. Shares could go down 30% before. If you walk away, they lose money. So they got a 30% buffer. Well, they want that 30% buffer maintained. And if the market goes down, they want you to sell shares to reestablish that 30% buffer. So now you're selling at the bottom of the market. You know, the bus slows down, you get off, and then the bus speeds back up again. That's the danger of borrowing to invest. And it's not just in shares, it's in every asset class. Borrowing to invest is terrific, but you got to look forward and reason backwards and think, how do I survive inevitable downdrafts in the value of the asset that underlies my investment? And so, look, the 2 ways to survive that are: 1, don't borrow too much. You know, instead of borrowing or having an LVR 75%, have an LVR 25%. Invest in an ETF that has a low amount of leverage. You know, Gen Life and some others are thinking about these kind of products, right? So, but in any case, don't borrow too much to invest in shares. That's one possibility. The second possibility is borrow against property, not the shares themselves. You know, if you borrow against equity in your home to invest in shares, doesn't matter what happens to the share market, you'll never get a margin call because the loan is secured by property and not by the shares themselves. So look, borrowing to invest is good, but you got to be able to survive a downdraft in the underlying assets without being driven out of your position. Jan says, hi Jan, hi Sam, what is the rationale of the 25% trigger point and the splitting it into 6? So the 25% trigger is ordinarily, I would say 20, that if you are fully invested, say you don't have any, you're not invested in the market, and then you want to slowly get into the market. So you think, okay, I'm going to invest over 2.5 years. Like you sell your business. So you started the business, you sell your business, now you got X million dollars, and so you're not invested. So you want to get in fully invested, but you don't want to jump all in one go, right? What if you jump in and then the market goes down? What if you don't jump in and the market goes up? The only way to balance those risks is to sort of average your way in, dollar average your way in. So you might say, okay, over 10 quarters, I'm going to put 1/10 of my money in each quarter. And I'm going to reduce that timing risk by getting in slowly. But then you think, well, if the market goes down a lot, I'm going to accelerate that process. And if it goes down enough, I'm going to go all in. And so how much does it have to go down for me to go all in? 20% ordinarily. Now, and why do I choose 20%? Because, look, if you make the number too big, then it could go down 20%. You didn't go all in and then it goes back up again and you've missed your opportunity. So, you know, you don't want to be too hungry and wait for it to go down a long way because you'll miss out. Okay. But equally, you want to get invested at lower numbers. So you need to choose a balance between those two things. And if you look at data historically, people who do that and get fully invested 20% off peaks do very nicely. Now, why 25% instead of 20%? Because the market's very highly valued at the moment. That's what it's a part of being more cautious. Spread out, instead of sort of averaging in over 8 quarters, maybe average in over 12 quarters. Instead of having your trigger points over 20% down, make it over 25%. It's a part of being more cautious. Hi, Sam, do you think that, Grant says, hi, Sam, do you think that the nature of competition in the AI era will be starker in terms of winners and losers, such that there is elevated risk of investors holding a smaller portfolio of market darlings, including the Magnificent Seven, than in prior periods? No, I don't. And look, and I think that some things are the most of the laws of economics and finance are enduring, right? And it's easy to think that this time it's different, but it isn't different. And diversification is your friend. And that isn't going to go away. You know, it's sort of natural to think, well, we know the Magnificent Seven are going to be the winners, so we should just go with them. But we don't know they're going to be the winners. We don't know what's going to happen. Diversification's your friend. So don't give up on it. Don't be invested in 7 shares. Be invested in the whole of the index. Well, what are your thoughts on the ability of the US to continue to be productive if it becomes a sequential autocracy? Well, it'll be less productive if it's a sequential autocracy. That's what I think. But look, if you're worried about President Trump, look, just think of the whole American project, right? Over the last 500 years, it is what it is, right? It's this incredible dominant thing in the world. And it was that before Trump, and it'll be that after Trump. It is, I was talking to someone yesterday at a barbecue who said, I'm never going to the United States again. I'm so upset about Trump. And I just thought, oh, what are you talking about, right? Like, you look at the United States, you look at that incredible dominant thing as the United States, and all you can see is this guy, Trump, right? And that's not how I think about it. So I'm not worried that America is going to fall over. I think the middle will hold, that people who take extreme positions in the United States will ultimately be sidelined. I'm not worried about it at all. What single indicator would convince you it's a bubble rather than rational repricing? Well, look, for one thing, there'd have to be some constriction on, this is why I sort of focused on the market efficiency versus bubbles aspect, right? So a necessary condition for it to be a bubble is that there has to be some constraining of negative opinions flowing into the market, like there is in property all the time. People who are negative about property and don't own it, they can't express their opinion, like there was in the dot-com bubble, like there was in the GFC. And when those constraints on negative opinions being expressed in the price by people taking action, when those constraints came to an end, both in the dot-com bubble and in the GFC, then the bubble was burst. Now, those constraints are modest in this, right? So there's that makes you think that it's not a bubble. So it's not really a sort of an indicator. It's just a sort of the structure of the flow of information that makes me think that it's not a bubble. But it's also true that, I guess price to earnings ratios would be a indicator. If they got too high, then we would start to think that there was irrational exuberance. But, for that to happen, there has to be this constraint on negative information. If the US is the epicenter of AI, and AI amplifies productivity gaps by allowing the most productive white-collar workers to displace the least productive, do you expect that over the next 40 or 50 years, US firms will increasingly absorb global finance functions, effectively hollowing out Australian finance sector and shrinking ASX 200's relevance? Well, there is a danger of that. Yeah, there is a danger of that. This kind of reminds me, reading your question, I was reminded of something that Doug said earlier about the US being a basket case. And I said that it's emphatically not economically a basket case. And look, I'm not stepping back from that. And I said the only sense in which it's a basket case is the problems that they have with debt. But that's true in a lot of other places as well. But look, there is another thing that comes to mind. I don't know why your question reminded me of this, but there is another thing that comes to mind, which is that throughout the talk, I was saying how disruptive I expect AI to be. That over a period of 50 years, you're going to get as much disruption or as much transformation as occurred over 200 years in the Industrial Revolution. And like one aspect of the United States that does worry me is that there's big fractures in the United States. So, and the big fractures are, putting race aside, which is itself is kind of a fracture in the United States, is between the secular and the religious, between the North and the South, and between the rural and the urban. And those three things overlap. And they're really deep fissures in the United States. And you can see, and this is maybe part of what Doug was referring to, he had in mind when he said the US is a basket case, that politically polarized it is, right? And how hard it is for people to reach across the aisle and to work with each other. Well, you compare that to the UK or Australia, we are not like that, right? The political parties don't get on with each other. But there aren't big divisions in Australia. There aren't those deep cracks in Australia that there is in US society. And when you come under the pressure of rapid transformation that AI, I think, is going to bring, then those cracks, the opening up of those cracks in the United States is something to worry about. And even though in Australia, people say we're very poor at managing prosperity, but we're good at managing adversity. And I think that's right. We haven't managed our prosperity very well in Australia, but I am confident that the pressure we come under in the highly transformative forces of AI over the next 40 or 50 years, we're starting from a good starting point, right? We get on with each other, right? And we don't have big arguments about small things for the most part. Anyway, sorry about your question. Do I think the US will hollow out parts of other economies? Look, I do think there's a possibility that will happen. And it's not just, there'll be aspects of the US itself being hollowed out. It is that I think that AI technology so collaboration across borders. Larry Summers is very big on the idea that from 1975 to 2020, in those 45 years, especially from 1980 to 2020, those 40 years, if you wore a uniform to work, globalization was very hard for you. If you wore if you didn't wear a uniform, if you went to work, looking like this, or if you went to work in an office, then globalization was good for you. You got to share in the benefits of it. Lower cost products and your superannuation went up. But if you wore a uniform to work, the competition from people competing for your job over those years went up and up. And now it's knowledge workers who are going to face that competition. And it's because the ability to collaborate across borders without actually moving. This goes back to the question about work from home earlier, right? The ability to collaborate for someone who's in Mumbai or in Manila, right, or in Lagos in Nigeria, to take your job because they can collaborate with other people who work for your firm. I think that's going to be vastly enhanced. And so it is going to be hard. It is going to be hard for knowledge workers. But knowledge workers are going to experience what people who wear uniforms to work experienced over the previous 40 years. Just a comment, Sam. I was speaking to a medical specialist and he recently witnessed a successful gallbladder removal using robots controlled by AI. That's what we made, right? So those specialists will be in Lagos in Nigeria before you know it. He was quite surprised at the success of the operation. There's clear areas of the economy where AI can make a difference. I think that's right. Couldn't agree more. One of my sisters is a radiologist, Liz Wylie, the head of breast screen here in WA. And hearing her talk about the effect of AI on imaging, it's quite amazing. If a lot of people lose jobs because of AI, how will it affect the markets? Well, we don't know, basically. But I would say, and this sort of goes to the growth of cash flows of companies. One way to think about it is that there is the factors of production that go into the economy. The main factors of production are labor and capital, labor and financial capital, which leads to physical capital. And it used to be that it'd be land, labor, and capital would be the main factors of production. And then there would be which one of those factors of production the value goes to depends upon relative scarcity. If there's a relative scarcity of land, more of the value will go there. If there's a relative scarcity of labor, such as happened after the end of the Second World War, or to take a more extreme example, in Europe, after the Black Death, where half of the peasants passed away, and now there's an incredible shortage of labor throughout Europe, then the percentage of production or value created that went to labor as opposed to owners of capital or land went way up. So it's about relative scarcity. Now, is AI going to increase the supply of labor, or is it going to increase the supply of capital? I would say it's going to increase the supply of highly educated labor exponentially. The ability to educate people around the world and for them to enter the global workforce. If you're a kid in Kenya or Nigeria, the ability to get educated by AI and then for you to connect through Starlink to the global economy means that the supply of highly educated workers that can come into the global economy, that could expand a lot. And if it expands a lot, more of the value is going to go to the other factors of production, and especially it's going to go to capital. And I think that's the important thing to think about. Could the percentage of global GDP that ends up as profits, and especially as profits of the S&P 500, could that go up a lot? I think that is what's going to happen. Both Bitcoin and AI represent disruptive forces. Yeah, I know, but one's about that big, that's Bitcoin, and the other one's about this big, that's AI. If you think about my 5 frames and thinking about how big AI is, Bitcoin's in the frame, in the 80-year frame, and it doesn't even make the list. So both Bitcoin and AI represent disruptive forces. Bitcoin as a decentralized financial asset, AI as a transformative, productive technology. Yep. Do you see any meaningful linkage between the two in terms of capital allocation, risk pricing, or their potential to reshape market structures? Or are they trajectories largely independent despite? Yeah, I don't see a big connection between them. And I don't think Bitcoin is that big a deal. Cryptocurrencies in general are a bigger deal than Bitcoin. But even they, compared to AI, are a small thing. But look, I have warmed up to Bitcoin. I used to think it was kind of a silly Ponzi game, but what's warmed me up to Bitcoin is that people are treating it as an alternative, and this is true of gold as well, right? And you're seeing how much gold price has gone up, and the shares of gold miners especially have gone up, that people are losing faith in the US dollar because of the slow motion train wreck that is US debt, and they see gold and Bitcoin as being a hedge against that. And so, because of that, I think Bitcoin might have more enduring value. So I have definitely warmed up to it. I don't own any, and I don't advise my clients to buy any, but I've definitely warmed up to it. But I don't think it's that big a deal, especially compared to AI. And I don't think that they are very strongly connected. What do you think will be the productivity impacts of non-Mag 7 companies due to AI? I think that'll be cost out to begin with. And then what it'll be is who can implement it? There'll be a big shakeup, and private equity will have a big influence on that. Private equity will come into companies. Look, if you can't implement AI, you're not going to stay competitive. So I think it's going to be highly disruptive, but to begin with, it'll be cost out rather than value accretive, delivering new, more valuable services than were previously delivered. I think it'll mostly be cost reduction to begin with. What other economic constraints should we think about when it comes to AI's growth potential? As opposed to CapEx. Look, I think CapEx is the biggest constraint. That's one. The other one we talked about is the possibility that AI winter will come along, that the scaling laws won't continue, and then there'll be regulation is a constraint as well, right? People get pretty freaked out about AI. So, I think that will be a constraint as well. Mark says, hi, Mark. Hi, Sam. Thanks for the presentation. Very helpful. A question about the looming US debt crisis you referenced. AI is a way out of that, or could it throw a spanner in the works? Well, AI is a way out of that. So if we get, if productivity goes up enough, the debt problem will go away. That is correct. If GDP grows fast enough, remember that GDP is on the bottom line. It's when we think about debt, we think about total debt divided by GDP. And if GDP grows fast enough, then the debt problem, even if it doesn't go away, it'll be pushed into the future a long way. And look, and that's a real possibility that we get a big surge of productivity. I'm still worried about it. Hi, Sam. Do you have a good book to recommend about AI? I don't, but what I would recommend is good. Look, one is Chip Wars. I know that's been out for 3 years, but I really enjoyed that. But I also say that there's really good podcasts on AI. One that I really like is the NVIDIA AI podcast, where they invite a lot of people along to talk about the implementation of AI. Because so the NVIDIA AI podcast. Another one is the BG Squared, and it's Brad Gurley, who's a long-term tech analyst, and another dude whose initials also BG, but I can't remember his name. But it's called BG Squared. That's a very good AI podcast as well. So, I would recommend those two. Wouldn't the AI journey eventually hit a substantial wall, considering how much energy, water, etc. uses and amount of emissions it generates? Yeah, well, that's a good point. So someone was saying earlier, what are the constraints? I was forgetting about energy, but energy should be right up the top. That absolutely is. The computation is energy intensive. But those kind of resource constraints, that's what innovation's all about, right? That's what economics is all about. It's about allocating resources and the science of the allocation of resources. And innovation and technology is all about creating techniques where you work around what the constraint is. Now, the energy compute bottleneck is not a simple thing to work around, right? Look, I don't disagree. And at the bottom of that is just sort of the connection between energy and information. It's a sort of the notion of entropy. So there's a fundamental physical reasons why you can't work around it. But look, we can get a lot more efficient. I think that's a real reason for the fact that tech companies, these big, highly resourced tech companies, face this energy constraint. I think that will end up being a very positive thing. It'll help with energy transition. That they want to use green energy. And they have the resources and just the innovative tech drive to bring it about. I mean, you look at the small modular reactors we were talking about earlier. I think it'll help in the end. But going back to the China versus the US thing, so a big advantage that China has is the growth in their energy. And I was forgetting about that earlier when I was talking about the advantages that the US has over China. Should have put on the ledger that the China's growth in energy production and that ability to support extra compute, we'll see how important that is. That could be a big advantage for China. Hi, Sam. Hope you're well. Cam Bradley here. Hi, Cam. Be great to catch up, Cam. Um, Here, I agree with your framing, but I'm interested in how you think AI, energy demand, and supply could play out in the US. Yeah, look, I think look, it is a big issue. Should have talked about it in the webinar. I think the US will be okay because there's a lot of competition between the states. There's an administration that's very conscious of the need to generate more energy. So I think other countries are going to struggle more than in the US. And they have a lot of capacity to generate electricity. They have a lot of gas in the US and they have good gas infrastructure in the US. So they'll be able to ramp it up. And look, I mean, it's quite natural to say, but won't they generate a lot of carbon dioxide? Well, it will. Will they care about it? Probably they won't. So will it be as big a constraint as it should be? Quite possibly not. Next question is, do you have a sense of how AI is going to increase company revenue in practice? Cost out. Oh, revenue. Okay. Uh, yeah, well, new products. Uh, and I know that's a statement of the obvious, but I think it's a statement of the obvious to say there's going to be new and better products. But what are those products going to be? I don't know what they're going to be. Basically. And I think that we would have to think about it industry by industry, basically. But I think it's going to be cost out to begin with. Ultimately, isn't AI just entry level cost, not a competitive advantage? I think that will be true to a certain extent. There will be a lot of new products, no doubt about it. You just think about financial advice at the moment, right? 90% of people in Australia don't receive any financial advice, but everyone needs it. Financial advice and finance education, and people don't get it, and they need it, and AI will bring it. So I think the one thing you could say is that a lot of AI products will be the provision of things that are not done at all at the moment. I also think that there'll be we'll see. Well, anyway, I think we're going to see some really good people paying a lot to use agents. Craig Rayner. Craig, it'd be good to catch up. Maybe you could send me an email, or maybe I'll save this thing. And while I'm not disputing the numbers presented, for something as transformative you suggest AI is, are the metrics and assumptions shown sufficiently decoupled to be predictive, or give they less useful in the face of significant social market change? Yeah, look, I don't pretend to make strong predictions. Really, in the modeling, I was just trying to figure out what prediction is embedded in the price. If the S&P 500 is worth 55 trillion, can we just put a bit of structure on valuation, and from that structure draw out what growth rate of cash flows to shareholders is embedded in the pricing of 55 trillion? That's really what I was trying to bring out, but I wasn't trying to make strong predictions. Like I said, the one prediction you can make from people making predictions about technology is that they'll be wrong. And that'll certainly be true about me. All right, I'm going to drop off now. If I haven't answered your question, I'm going to apologize here and wind it up. So thanks very much for coming along, and we'll see you at the next one. And if you haven't taken my course, don't forget about it. Cheers.